This example looks at cash dividends when we have both preferred stock and common stock. So preferred stock has preferential treatment in receiving dividends. They have guaranteed dividends, while common stockholders do not have guaranteed dividends. So they will only receive dividends after the preferred shareholders have been paid. So we are going to look at an example with non-cumulative preferred stock and then cumulative preferred stock. So we'll look at the non-cumulative preferred stock first. In this, we have 7.5% preferred stock. That means that they are guaranteed a 7.5% dividend on the $5 par value of that stock. So when we look at how much is that dividend, we take the $5 par value times 7.5%. Then we take that amount times the 80,000 shares outstanding of preferred stock. So every year we have a guaranteed preferred stock dividend of $30,000. So if we are going to look at who gets what kind of dividends for our preferred stock and our common shareholders, in year one, we have a cash dividend of $20,000. Because our preferred shareholders have a $30,000 dividend, they get 100% of that $20,000, and there is none left over for the common shareholders. This also happens in year two. Because the preferred shareholders get the first $30,000 of any dividend, they get all $28,000 in year two, and the common shareholders get nothing. In year three, they get their $30,000 and the common shareholders get the remaining leftovers. This also happens in year four. They get their $30,000 guaranteed and the common shareholders get the remaining $320,000 split between them. So that is when we have non-cumulative preferred stock. In this next example, we have cumulative stock. This is the same information, but now it's cumulative stock. When it is cumulative, that means that preferred shareholders are not only guaranteed $30,000 a year, but the company has to make up that to a full $30,000 if they don't pay it in each year. What they do is whatever they haven't paid gets put into an account called dividends in arrears. So in year one, when we pay $20,000, the preferred shareholders get all $20,000, common shareholders don't get anything, and we still have that other $10,000 to get up to their $30,000. So now we have dividends in arrears for year one of $10,000. In year two, when we pay $28,000, preferred shareholders get all $28,000, common shareholders get nothing, and we have $2,000 left until they get $30,000. Now we're in year three, where we have this $200,000 dividend. Because the preferred stock is cumulative, that means we have to pay them their $30,000 and all of their back dividends or their dividends in arrears before we can give the common shareholders anything. So we have to give them their $30,000 plus the $10,000 from year one and the $2,000 from year two. And common shareholders get whatever is left over. And then in year four, we no longer have any dividends in arrears. So preferred shareholders would get their $30,000 and common shareholders would get the rest. Our next example looks at treasury stock. Treasury stock is when companies buy back their own stock from the marketplace. They do this for multiple reasons, to avoid a hostile takeover, to remove supply in the marketplace in an effort to increase demand, which then increases the price of their stock. When we look at treasury stock, we pay market price for treasury stock, and we record it in an account where it's shown as a negative balance on the balance sheet. So we show treasury stock as a contra equity account where it's shown as a negative balance, much like we do with accumulated depreciation. So when we purchase these 5,000 shares of common stock at $25 per share, we receive treasury stock $5,000 shares times $25 a share, and we pay cash of $125,000. Then on November 1st, we sell 1,000 of those shares for $31 cash per share. So we receive cash of $31 times 1,000 shares. And then we remove treasury stock. Because we paid $25 a share for that, that's the amount that we can remove from our treasury stock case. So we remove that at 1,000 shares times $25, which is our basis in the stock. The remaining $6,000 goes into a paid in capital treasury stock. Then we sell the remaining 4,000 shares on November 25th for $20 cash per share. So we receive cash, 4,000 shares times $20. We no longer have any of that treasury stock. So that was 100,000 because we had 125,000. We removed 25,000. We had 100,000 left. We have to make up this $20,000 difference between the cash we received and our treasury stock. So first we do that with the paid in capital treasury stock. $6,000. Now we have a remaining $14,000. That comes out of retained earnings, just like any of our dividend payments do. So that is because we sold that treasury stock back at a loss of $5 per share. This example looks at a statement of retained earnings. We've seen statements of retained earnings in multiple chapters. This chapter adds what happens when we have a prior period adjustment. So retained earnings is beginning retained earnings plus net income less dividends gives us ending retained earnings. When we have a prior year adjustment, we calculate that in, and then we have adjusted beginning retained earnings. So in this example, we start with prepaid beginning retained earnings of $1,375,000. We then see that 2 years ago, we forgot to record depreciation expense of $55,000 net of tax. That means they've already calculated for the income tax difference. So we need to subtract that expense. We would have had less income 2 years ago, the income that eventually got closed to retained earnings. So now we have adjusted beginning retained earnings of $1,320,000. We add our net income of $126,000 and remove our dividends of $43,000. So our ending retained earnings is $1,403,000. Our last couple examples are looking at the various ratio analysis we calculate to determine how good of an investment a stock is. So one of those main ratios is earnings per share. Earnings per share is net income available to common shareholders divided by the number of average shares outstanding. So we have $960,000 of net income and $120,000 cash dividend. So the net income available to common shareholders is $960,000 minus the $120,000 that is going to preferred stock. So the company's basic earnings per share is the net income available to common shareholders divided by our 400,000 weighted average shares, or $2.10. This example looks at the PE ratio. The PE ratio is one of the main ratios, along with the dividend yield, which we'll look at next, that looks at the growth opportunities for stock in the financial market. When we look at the PE ratio, this is the market value per share divided by earnings per share. So we calculate the PE ratio for each of these companies. We might have looked at the dollar amount of the earnings per share and the market value per share and thought that the ACOR stock was the best stock. But as we see with the PE ratio, the best stock as compared to earnings per share and the PE ratio together is the Hilton stock. Dividend yield shows what growth potential a stock has, along with the PE ratio that also looks at growth potential of stock. In the dividend yield, we take the dividend per share divided by the market value per share. So we see that the dividend yield for these stocks is highest for the United stock, even though the other stocks might have a higher dividend per share. Our dividend yield shows better growth with the United stock. The last example in this chapter is the book value of common stock. So the book value of common stock is different than the market value of common stock. The book value of common stock shows kind of the carrying value of common stock. So this is our stockholders' equity minus any preferred share information divided by the number of shares of common stock. So we would have the common equity available to shareholders, common shareholders. So this is our total equity minus any preferred stock amount. So our common stock book value is that amount divided by our shares outstanding of 100,000. Or $13.35. Then it's asked, what is the book value per share of common stock if preferred dividends are 3 years in arrears? Well, in addition to the preferred amount, we would also have to remove those cumulative dividends in arrears. We have $25 par value, 6% dividend, and 10,000 shares. So $25 times 6% times 10,000 shares. So we have an annual dividend of $15,000. So now the equity available to common shareholders is our total stockholders' equity minus the preferred stock minus 3 years of dividend payments. 15,000 times 3 is 45,000. So we would take that amount divided by our 100,000 shares outstanding, and our common book value is $12.90. Those are all of the examples from chapter 11.